and welcome to another episode of The Jason Show on my CPE, where we talk to accounting and tax professionals about a variety of different topics relating to taxes, accounting, practice management, and advisory services. And I think the topic today probably falls under the all of the above heading. We have Alex Dyo with us, and Alex is from Wealth Excel. And first of all, Alex, hello and welcome.
Yeah, thanks very much, Jason, for having me. So looking forward to bring and or provide any insight about the strategies that we have.
Well, absolutely. Let's start. I always like to start by having people introduce themselves. So I guess before we introduce who you are, let's talk about Wealth Excel. And then we'll ask a little about you. What is Wealth Excel? Who are you and what do you do?
Yeah, absolutely. Wealth Excel is a boutique wealth management consulting services, focusing mainly servicing the needs of high net worth individuals and business owners that make a lot of money and for obvious reasons would like to save on taxes, create pre-tax wealth, and essentially pass on these wealth to the next generation. So it's all about wealth or around the wealth that we are helping clients to create.
Okay, and you are the managing director there. So tell us a little about yourself, who you are, a little of your background, and what you do with Wealth Excel.
Yeah, so I started my financial services career back in 2003. That would be, wow, 20 years now. And my career started as an insurance agent, and quick enough, I've obviously evolved into more of a holistic planner. And after that, became more of a focused planner. So now our firm is called more of a surgeons in the financial services rather than generalist, if you will, predominantly because the type of services that we provide are very particular and catered to a specific type of audience. My career obviously been through various cycles, like probably anybody who is in this field. But I am certainly in the place where I love what I do and helping people with their tax savings and creating massive wealth for the next generation to come.
So the specific topic we want to talk about today is charitable gift financing. And we have a number of things to work through on that. But let's start with, for those who may not have heard of this, what would be like the 30-second or 60-second elevator pitch type of explanation of what charitable gift financing even is?
Yeah, Jason, this is a very interesting strategy to begin with, but a 30-second elevator pitch, anyone in this country is able to finance any type of transaction, whether that would be a real estate transaction, a car purchase, a business purchase. So everything is done through leveraging. Why not gifting or precisely charitable donations? And that is exactly what the charitable gift financing is a opportunity for anyone who has high expectations as far as giving a lot more than they otherwise could with respect to the cash flow. They can go out and seek financing. And as a result of that financing, their cash flow is not impacted as much because the dollars are coming from a third party. And the good news about that too is that when they borrow those funds and those funds are going to the charity, 100% of that cash that came from a third party is 100% deductible based on the revenue ruling 7838. So that's probably the simplest way to explain what the strategy. There's nothing complicated about it. It's all based on you borrow, you give, you receive tax deduction.
All right, so we're going to get into some specifics of this now. So is there like a target audience or target market, target individual, I guess? Who's the ideal candidate for doing something such as charitable gift financing?
Yeah, that's the rhetorical question, if you will, by many of the clients that we work with, or advisors, as a matter of fact. Who is the ideal client profile? Well, first and foremost, the person who is charitably inclined is a number one qualification, if you will, for the strategy to work. Number two, of course, on the financial side, they have to have minimum amount of income that would support their desire to give substantial amount of cash. And in our view, that would be someone with $750,000 plus in AGI, with a net worth of approximately $3 million plus. So it's kind of a combination of both. So A, being charitably inclined, wanting to give large sums of money, either one time or over time repeatedly, someone who makes $750,000 plus in AGI and having a net worth of $3 million plus.
So you answered a little bit of this during my question about the 30-second elevator pitch, but let's talk a little more about the mechanics of how this works. If someone meets that profile and they want to do this, and I'm sure it's a multi-step process, it's fairly straightforward, it sounds like, but like how do you even get started in something? So what would be the first step for someone who's interested?
The first step, we have every single client of ours go through a charitable questionnaire, because this is the beacon or the foundation of even establishing the understanding of who we're dealing with, from the standpoint of clients' charitable inclinations, their desires, their philosophical attitude, and so on and so forth. After they fill out the questionnaire, we would know whether we have a potential lender for this type of a client or not, based on specifics that they outline in their from their answers that we gather. That's number one. Number two, once we pass that and we have indication that this particular client potentially is a good candidate with respect to the inclinations is concerned and their desires to give, then we go through more of a financial side of pre-underwriting, asking them their financial situation, their net worth, what is it and why their desire to give certain amount of cash. And once we establish that, we have a profile that is potentially a good candidate to go through the full underwriting. And based on that, we show them our feasibility proposal and analysis put together for them, and walk them through on what are the steps that we need to take, what it would intake, how long it takes for us to, from start to finish, complete the full underwriting. And as you can imagine, as you said as well, there are many steps involved. However, having us as Wealth Excel, we are the coordinator, if you will, or others call us a quarterback. And we essentially put together everything from start to finish, anything between coordinating the proper pre-qualification to the full underwriting, origination of the loan, life insurance as one of the collaterals that is used as part of this transaction, and coordinating also the charitable receipts that should be given to clients after the transaction complete. Predominantly, there are. Oh, sorry.
No. You go ahead, Alex.
Yeah, so just one item to highlight further. So before maybe your next question, the basics are there are three parties involved. So number one is the client who desires to give large sums of money. Number two is a loan provider. And number three, a charitable organization. So all of these three parties obviously play a certain amount of role in this transaction. And the coordination is essential when it comes to dealing with the client and their expectations, as well as the lenders and their requirements, and the charity who obviously all about providing and doing providing public benefits, or larger public benefits, I should say, but all of them do have certain criteria, certain requirements, and certain benefits that they all each receive.
I want to come back to a few aspects of that, but before we get to that, you had mentioned the 700,000 AGI, 3 million of assets. When we're talking about the size of loans that people typically take out on this, what is the average, if there is an average, I guess, of the size of loan that you typically work with?
It's a very good question. It all boils down to, again, the questionnaire that they fill out and the amount of cash that they're willing to give, whether it's a one-time cash donation or whether it's a repeated process. But on average, I would say our clients giving anywhere between $500,000 to about $1 million. And the size of the loan typically ranging anywhere between $400,000 to about $900,000 or so.
All right. So I think you touched on this with life insurance as the collateral in a lot of cases. That was going to be my next question. What is the collateral? What's the backing on these loans typically for the bank?
As you can imagine, this is a very different space than we would probably see in a traditional lending space. The loan providers that provide capital for these types of transactions, they're not your typical Bank of America, Chase, or any traditional banks, if you will. These lenders are specifically lending on the basis of charitable giving. And one of the collaterals that they use, and I should say the only collateral there is a life insurance, because the life insurance is a non-correlated type of asset to any type of assets that we deal with, whether there would be public equities, real estate, maybe even non-publicly traded stock of private companies and so on and so forth. So life insurance in that sense is very unique, because we all have one certainty in this life that one day we all end up in a different world. It's not a matter of if, right? It's just a matter of when. So
right.
For that particular reason, the lending space that we're working in, they have this life insurance requirement to have as a collateral, because they know at the end of the day, when the person passes away, the death benefit pays out, and that's the mechanism to satisfy the loan.
So someone gets one of these loans and they put the money towards a charity, and they get the tax deduction. They reap a benefit of probably 35 to 37% of the deduction or the dollar amount of the donation. So there's a big immediate return or almost immediate return on that. It seems to me like the tax benefit probably outweighs the interest that people would pay. Maybe I'm making an assumption there, but it sure sounds like it does.
Oh yeah, absolutely. So we call it, or I should say, a lot of people that we deal with, they essentially have told us this is a beautiful perpetual generational giving that is created. Whether that giving is done today, and for obvious reasons, there's a benefit as far as the tax savings for any cash donations that is in place. But at the same time, when the life insurance paid out, that the same amount of dollars that repays the loan goes back to the same system of giving, which means it's like a cycle where these dollars are essentially circulating in a way that A, the cash was given, B, the cash is or the capital is repaid through life insurance, and then that the same capital goes back in the system to continue the giving. So to kind of highlight this, the fact that this is a beautiful thing, in my view, it's just absolutely fascinating to me when you give more, you receive more. So whether it's today or it's tomorrow, and the tax savings, yeah, absolutely. So depending on the state where the person resides, we're talking about a combination of federal and state, potentially, as far as the tax savings is concerned. The interest rate is AFR mid to short-term rates, and presently it's ranging anywhere between, well, in this current interest rate environment, anywhere between 1.87 and I think the most current rate is about 2.8 or so. Last year, we dealt with an even lower interest rate environment at around 1%. So considering that even on the federal level alone, we're talking about 32% or so. Well, I live in California, plus additional maybe 7-8% effective tax rate on the California side. We're talking about 40%. So it takes roughly about, I would say, what, 20 years or so to break even on that tax savings when it comes to the interest is concerned. But that interest is repaid through a life insurance death benefit. So, and that's a beautiful thing because there's nothing out of pocket essentially during the term of the loan, and the loan is repaid through a life insurance. So the client received the tax savings immediately at the time the cash is given, and the interest, yes, it does accrue, but it's repaid through a life insurance at the end of the day when the person passes.
So these loans, they're not actually making monthly repayments on them. Then it's whenever they pass away, the life insurance policy part of it goes to paying off the loan. Is that how these are set up?
Yeah, a little bit of details, I guess. They would prepay as part of a transaction, either 2 years or 3 years worth of interest in the beginning. And from year 3 or 4, depending on the loan providers we deal with, it starts to add to the principal of the loan, which eventually is repaid through a life insurance death benefit.
So I guess this next is more of a statement that I'm making rather than a specific question. But in the charitable contribution arena, you have conservation easements, for example. A lot of higher net worth individuals do, but there's a lot of danger with that. The IRS is really cracking down on that, the overvaluation of property and potential. And I think some of the companies that have done that have even been like raided by the IRS and shut down. There's lots of audits. This seems like something, and this is just cash, a cash contribution. It seems like it's a much safer avenue for someone to go down if they want to make a charitable contribution. That's more of a statement, I guess, than a question, but that's just my thought on it.
Yeah, I think, Jason, you absolutely correct. Everything you named, I don't say there are bad types of strategies, but certainly we've seen a certain level of abuse. Here, we're dealing with cash. There's no doubt about it. And IRS specifically says, and that it's not me, it's not you, it's not nobody. It's not a gray area at all. It's a black and white. There is a revenue ruling 7838. And precisely, essentially, if I were to verbatim read it, it says that the IRS has ruled that the debt to a third party is used to make a charitable contribution. The taxpayer is entitled to a charitable contribution deduction under RSC section 170A in the year the gift was made, and the deduction may not be postponed until the taxpayer repays the indebtedness. So, and that is written in the law. And to me, that's why I really love this particular strategy, because I don't need to create and or do anything but just rely on this specific revenue ruling. But more precisely, if I have all parties involved and everybody's agreed as part of a transaction, cash is given to the charity. Charity cannot say, "Oh, I'm sorry, we didn't receive the cash." That's absolutely impossible. So they provide the receipt to the extent of the amount that was given to the charity. That's a proof. So it's not inflated version of evaluations that we're dealing with. Nothing. It's just the cash.
And how much choice do people have in terms of what charities they give money to? Are there restrictions on anything on that? I know the IRS probably wouldn't have that, but are there anything that lenders would put in place as far as restrictions on who people can donate the money to?
So essentially, it all boils down to the questionnaire and the client's charitable inclinations. And those charitable inclinations are matched with the mandates that the lenders do have. And that's essentially how the matching process works. So there's not necessarily restrictions, but there is certainly certain aspect of matching that has to take place because, for instance, if charitable inclinations of the clients are more on environmental kind of incentives, where the lenders are all about providing shelter to homeless, there's obviously a mismatch. So for those reasons, it's not restrictions, but more of a matching that has to occur.
All right. So we also need to talk about like trusts, grantor trusts, and how that might tie in here. And I understand when we get into trusts, that can be really tricky, especially in this format where we're just having a conversation and we could probably talk for several hours about things like grantor trusts. But just in general, how would something like that work with doing this idea?
Well, for us, we're all about creating layers of adequate protection and privacy for the client. One of the roles that the Grantor Trust plays in this transaction is providing privacy to the client, because as you know, that the public charities, they may choose to list the large size donors on their tax returns in Schedule B. And not many clients potentially are keen on being exposed as far as the large sums of money that is given to the charities. As a result, the Grantor's Trust is used to provide that privacy in place, because all of the benefits as far as the taxes, it's a revocable trust, obviously, that trustees have ability to manage. And all of the tax savings are passed on to the grantor. However, the privacy is protected and is in place, because only the grantor would know who is the trustee and the grantor on the trust. So with that respect, that is a beautiful privacy protection in place. Second, the borrower in this transaction would be the Grantor's Trust. And we purposely would like to see it this way. And that is to create additional layer of protection to shield clients' personal assets from any potential lenders' foreclosures is concerned, or what if there's not enough collateral and now the difference could be called, and obviously a client may be on the hook, although this is again another beautiful thing, that this is a non-recourse loan. So, and being as a non-recourse loan, having a grantor's trust as a borrower creates additional layer of protection for the client from even the economic standpoint. That's why we use the grantor's trust.
All right, so you mentioned that Wealth Excel is oftentimes thought of as the quarterback on all of this. So if a lot of our audience is tax pros, tax preparers, CPAs, accountants, and so forth, and sometimes on these charitable things, there's strategies that get brought up that I'll bet a lot of our audience hadn't even thought of something like this. So if say a CPA hears this and it's like, that sounds interesting. What could Wealth Excel, like, who do you work with on your side? Do you work with accountants? Do you just work with individuals? How would it work to get a relationship started with your company?
Yeah, thank you, Jason. Majority of our clients come through actual referrals from CPAs, because they see value and they certainly recognize the opportunity for the client to save on taxes and gift large sums of money to charities. So they contact us and we go through the brainstorming session essentially, and kind of looking at the profile of what we're dealing with. And we put together a feasibility proposal for those CPAs for them to initially speak to or present, or potentially even just introduce the strategy to the client. And once that happens, the client has a general interest or genuine interest to even explore further, they introduce a client to us, and everybody's participating in the Zoom session such this, and we go through every single part of a transaction, what it's involved, who is involved, how it works, how long it takes, how much it costs. It's a full disclosure. We show them exactly what the fees are, what the costs are, and who are the parties to the transaction. So the clients understand, or at least we attempt to do everything possible for the client to really be fully educated before they even enter in this transaction. So just to summarize, predominantly the source of clients we have come from CPAs. Number two, it's more of a partnership, if you will, that could be created in the sense to help client to achieve the tax savings through the strategy that we have in place. We provide all of the backup when it comes to the tax codes to CPAs for them to feel comfortable. Client also gets, I forgot to mention, an opinion letter from a tax attorney. So all of that is just to create a massive benefit for the client. And again, the audience we have probably, if they were to see a value in this strategy, we encourage them to contact us and brainstorm. So it wouldn't hurt to even just explore.
And one of the things you mentioned earlier that you do as part of your quarterbacking of everything is coordinating getting the receipt, because even though this is a safe thing, cash contribution, there's not much the IRS could question. It's a large enough amount that they could come in and say, well, do you have the receipt for this? Because charitable contributions, if you don't have the receipt, they'll disallow the deduction, which of course would be disastrous on a $500,000 charitable contribution. So you help to coordinate that the charitable organization provides the proper documentation to the client to make sure that their deduction is safe, correct?
Oh yeah, absolutely. And that is part of our value proposition that we bring to the table, is not only underwriting and coordinating the loan process, life insurance process, but also coordinating the receipts for the clients to receive. So that serves as a proof for them to show to IRS that they've made these donations.
Well, this is a fascinating topic, charitable gift financing for making charitable contributions. Alex, is there anything that you feel like that we haven't covered and that we need to cover, or do you think we've hit the things that your typical practitioner would need to know about this subject?
Well, I think the devil is in details. And I certainly encourage every professional who may listen to this podcast to contact us. And we can go through the details and showcase every code there is to justify and obviously show them that this strategy is black and white. There's nothing gray about it. We're not talking about those inflated type of strategies. But again, we are encouraging every professional to get in touch with us, to brainstorm and ask any questions. So if professionals become comfortable, they're certainly comfortable to introduce the strategy to their clients. And if their professionals are comfortable, I'm sure clients would be more comfortable and willing to explore. So it all boils down to the relationships that could be created and providing all of the backup and the substance as far as the strategy is concerned.
And what's the best way if someone wants to get in touch with you to set up a strategy session, an initial call with you? What would be the best way to go about doing that?
Yeah, I'm fortunate enough to have my right hand. Her name is Angie Tasson. So she is my coordinator. So effectively, they can contact Angie at 213-302-8000. And she will obviously go through a process of understanding first and foremost what we're dealing with, and then put me on the calendar to go over all of the details that are in place that need to be discussed.
All right, that's Alex Dyo with Wealth Excel. Alex, thanks so much for joining us today to talk about this very interesting topic, and hope you have a great day.
Thank you, Jason. Appreciate your time.
All right, very good, Alex. We've got that one in the can.
All right, fantastic. Thanks, Jason.
All right.
Appreciate it.
You bet. Thank you. Bye.
Bye.